Trading the sector ETFs. We're going to take a look at sector ETFs today. We're going to have a little fun with it. Let's do it. So ETFs eliminate single stock risk by creating a basket of underlyings. And they also allow traders to avoid earnings. Trading ETFs is a great way to add an extra level of diversification to a portfolio. There are many types of ETFs, including market ETFs, leverage ETFs, sector ETFs, and volatility ETFs. Okay, so I want to stop right here for a second. The reason we talk about kind of sector ETFs, why we do this segment today, is because we have a lot of customers that have smaller accounts, hence the Tasty Bites logo at the top. And Tasty Bites are for accounts that are between 2,500 and 25,000. They're subject to pattern day trading rules. You don't want to put up the amount of money that you have to put up for, let's call them market ETFs. So market ETFs are what we primarily trade, like spiders, Qs, IWM, and those would be the three biggest market ETFs. Those would be the three that are the most liquid, that we trade the most. Sector ETFs we're going to talk about today, those would be like just individual sectors, and we'll show you why those are interesting. Leveraged ETFs, we do not trade a lot of. The reason for that is because we prefer futures. For customers that can't trade futures, they might like leveraged ETFs. For us, futures are far more capital efficient than leveraged ETFs, but if there's a certain underlying stock or there's a certain underlying future and you like the leveraged ETF, certainly go right ahead. There are probably hundreds, if not, there's probably hundreds of leveraged ETFs. Volatility ETFs.
Not all of them are very liquid.
Not all of them are very liquid. Make sure they trade millions of shares before you trade a leveraged ETF. But they have them for gold. They have them for, different precious metals. They have them for bonds. They have them for everything.
Sure.
Stocks, individual stocks like Tesla, they have leveraged ETFs for everything. They also have volatility ETFs and leveraged volatility ETFs. We rarely trade those. We will trade a little bit of VXX, but for the most part, we don't trade a lot of volatility ETFs. We don't trade a lot of leveraged ETFs because leveraged ETFs are not really that capital efficient. Volatility ETFs are just not that good.
They charge you twice the amount of buying power,
exactly.
Sometimes more.
Yeah, exactly. And sector ETFs actually make sense. We do trade a lot of sector ETFs. Like we'll trade the financials, we'll trade different oil ones, we'll trade, bond sector ETFs. So we'll trade some of those. So today's segment's on sector ETFs. Next slide, please. So we like to keep short premium in the equity indices, but the buying power reduction for an underlying like the SPYs or IWM can be a lot for Tasty Bites traders. Like to trade IWM, $2,100 just for a 16 Delta Strangle. Buying power for SPY, 7,500. Oof. That's a lot.
That's a lot
for a small account, especially if you're in the.
Yeah. That's why it makes IWM so much more attractive.
Yep. Let's go next slide.
Plus the
but those numbers are still high. So what if we went to some of the more popular sector ETFs? XLP, XLF, XLU, XLV, XLI, XLE. There's a million of them, by the way. Yep. These are just some of the more liquid ones, number of holdings, just to get an idea. That's so you don't have to deal with earnings risk or dividend risk or any of that kind of stuff. The sector ETFs have less holdings than market ETFs. They focus on a single sector of the economy. These represent possible trades and add diversifications to our portfolios. All of that is very true. Next slide, please. So to gain short premium using these sector ETFs without using as much buying power, the SPYs, like we said, right now, if we look at 59 days out in the SPYs, the last slide was an average, but right now, the straddle credit in the SPYs is $11, and it requires $10,000 in capital. But to sell a straddle in XLF, $700 or $800. XLK, $4,000, XLY, $3,000, XLV, $2,000 or $3,000, XLI, $2,300, XRT, which is the retail sector, $1,400. And you don't even have to use these. There's lots of other ones.
Sure,
we're just showing you.
These are popular, that's all.
Yeah, it's just a fraction of what the SPYs are. Smaller accounts, same strategy.
But I get the allure of trading SPY because it is the market. If you have an opinion on the market, you want to trade the market, that's the SPY. So you could easily, for not too much reduction in credit either, mimic whether it be in an IRA account, mimic the $10,000 that SPY uses, or even in a margin account or any other account, buy the wings and reduce the amount of buying power that you need maybe reduce the credit in the straddle by a buck or so.
Next slide, Beth. So most of these ETFs have higher implied volatility than the SPY, indicating great trading opportunities for premium sellers. They also have lower buying power requirements, making them a great option for tasty bite accounts. So high volatility and lower buying power requirements. So you can see right here, based on implied volatility, all of them except XLP and XLV are above the SPY as far as implied volatility goes. Let's go next slide. Since 2010, the 45-day straddle managed at 25% has been consistently profitable for these ETFs. We went back and we did a lot of research for this. And we looked at the financials, technology, consumer discretionary, healthcare, industrials, and retail. And the straddle success rate, this is managing at 25%, has been quite good. And we looked at average profit as a percent of underlying price. So just to give you an idea, the financials, go back one slide, Beth, for a second. 2 slides, one more. The financial straddle credit was 205. Okay, go back up 2 slides, but to the 6. So you're keeping what is that average of underlying price? I didn't. I didn't
read the.
Sorry, I was getting the wrong number. I was looking at the credit, so my bad there. So I can't tell you what the actual number was, but the success rates have been pretty consistent across the board for straddles at 25%. And this is without any management. Let's go to the next slide. So traders looking for short premium equity trades with smaller buying power requirements and diversification similar to SPY can use different sector ETFs. The smaller BPR lends to tasty bite traders' ability to be more strategic and selective. Implied volatility has been historically overstated in these sector ETFs. Just be careful when volatility gets really cheap anywhere. But in the sector ETFs, we mix and match with those just to keep ourselves active.
Let's take a quick 90-second break and come back. We'll prepare for the opening bell next. You listen to Tasty Live.